JP Morgan wrote a report, sent it to their biggest clients, and never once thought about sending it to you. That is the game. That is how it works. The people sitting on billions of dollars get a detailed breakdown of exactly what is happening in this market, exactly what the risks are, and exactly what to buy in each scenario. And you, playing the same market, owning the same stocks, exposed to the same macro forces, you get told to stay calm and think long-term. Today we go through the whole thing. Now before the numbers, I want you to really sit with this for a second. JP Morgan's institutional clients are not wealthy individuals with a brokerage account. These are funds. Sovereign wealth funds. Pension funds managing the retirement savings of millions of people. The kind of entities that when they decide to move into a sector, that sector moves. JP Morgan writes this market intelligence report and sends it directly to those clients with the full scenario analysis, the sector calls, even the specific stock categories. Literally telling the biggest money on earth what to do and when. Retail investors get nothing. Right. So let us fix that. The report covers the current situation in the Middle East, specifically the ceasefire that is either holding right now or about to fall apart depending on the day. And JP Morgan runs two completely separate playbooks. One for if it holds. One for if it does not. Two scenarios. Two totally different sets of winners and losers. The big money already has both mapped out. Let us start with the headline number. JP Morgan is targeting the S&P 500 at 7,200. That is their official call. If they are right, and they are usually right about direction even when the timing is off, then the panic selling you have been watching over the last several weeks has been people dumping their positions right before the recovery. Think about that for a moment. The people who are most scared right now, who have been selling the hardest, may be making exactly the wrong move at exactly the wrong time. And the reason they are making it is because they do not have access to what we are about to show you. This is the information the big money uses. The framework that moves billions of dollars. And by the end of this video, you are going to understand it as well as the people on the other side of your trade. Stay with us. The sector JP Morgan is most excited about in this report is tech. And I know that is not a surprise. But the reasoning behind it is important because it tells you something about the timing of what is coming. There are two things stacked on top of each other here. First, earnings season is approaching and the expectation is that tech results are going to come in better than what the market is currently pricing. Analyst estimates going into this season have been revised down. Cautious. And when you have cautious estimates and the actual numbers land strong, the share price reprices upward fast. That is not opinion. That is just the mechanism. Second, tech has been absolutely clobbered during this conflict period. Share prices across the sector dropped hard. The AI investment cycle came under the microscope. People started questioning whether the spending was sustainable, whether the returns were real. All of that uncertainty hammered the valuations. But here is what you need to understand about sectors that get sold down on uncertainty. When that uncertainty starts to lift, even partially, and the fundamentals underneath turn out to be intact, the reversal is not gentle. It is violent. Because new buyers come in, short sellers have to cover their positions, and institutions that de-risked have to rebuild their exposure. All of that buying hits simultaneously. That is not a slow drift upward. That is a snap. JP Morgan is essentially writing a bullish case for the Magnificent Seven, the 7 biggest technology companies in the US market. Earnings will surprise to the upside. Institutional sentiment has shifted heavily bearish on these names over the past several months. And when bearish consensus meets positive earnings surprises in a sector this large, the catch-up trade can move extremely fast. There is also the information gap to consider. A lot of retail investors, if you are one of them, put tech in the comments. A lot of tech investors have been sitting in pain watching their portfolios get marked down and wondering if this is the start of something worse. The report is saying no. The report is saying this is the setup for the other direction. The beaten-down tech sector heading into an earnings season with suppressed expectations is one of the most classic recovery setups in markets. That is scenario 1 of the bullish thesis. Earnings act as the catalyst. The beaten-down valuations provide the gap for a violent re-rating. And there is a second mechanism on top of this that most people never even think about. We get to that in the next segment. Hedge fund leverage. I know that sounds like something you tune out. Do not tune this out. Here is how it actually works. A hedge fund does not just invest its own capital. It borrows on top. So say a fund manages $1 billion. On the conservative end, they borrow an additional $100 million to trade with. But that is not normal. What is normal in this industry is that a fund managing $1 billion might be running $25 billion or even $40 billion of total market exposure by borrowing many times over its base capital. That leverage amplifies everything. When positions go right, the gains are enormous. When they go wrong, the losses are enormous. And when hedge funds add leverage to the market, the buying pressure pushes prices up. When they remove it, the selling pressure drags prices down. JP Morgan's data shows that hedge funds dropped their leverage dramatically over the last 12 months. They looked at the geopolitical mess, the macro uncertainty, the tariff disruption, and they pulled back hard. Current leverage levels are well below where they were at the peak over the past year. Now stop and think about what the other side of that looks like. If the geopolitical situation stabilizes, if the ceasefire holds, if the macro headwinds start to clear even a little, those same hedge funds are not just going to start buying. They are going to start borrowing and buying. They are going to turn the leverage dial back up. And when that capital floods back into a single sector, the buying pressure is not a trickle. It is a flood. Billions of dollars of institutional capital moving at the same time in the same direction. Which sector do they rebuild first? Tech. The sector where they cut exposure the most aggressively on the way down is where they rebuild the most aggressively on the way back up. That is how institutional positioning has always worked. So layer this on top of what we already talked about. Earnings surprises coming in tech. Share prices beaten down. Valuations suppressed. Institutional sentiment at maximum bearishness. And now on top of all of that, hedge funds sitting with deleveraged books that are ready and waiting to reload the moment the signal clears. That is three separate forces all pointing in the same direction for tech at the same time. JP Morgan's institutional clients understand this setup perfectly. And now you understand it too. Now let us talk about retail. About you. About what the everyday investor community has been doing over the last several weeks. Because the data here is genuinely stunning, and I think it is going to make a lot of people feel seen in a way that is not entirely comfortable. According to JP Morgan's intelligence report, retail sentiment has been running at extremely low levels. And retail investors have been net sellers of stocks on 7 out of 8 trading days this month. 7 out of 8. That is not someone taking some profits off the table. That is a full-scale structured retreat from the market driven by fear. By headlines. By the feeling that everything is falling apart and getting out is the only rational move. Now here is what JP Morgan's own historical data shows about moments that look exactly like this one. When market positioning gets this one-sided to the downside, when retail is selling this aggressively while institutional positioning is simultaneously this bearish, the following 3 months have historically delivered an average return of 8.2% on the S&P 500. 8.2%. In 3 months. Based on JP Morgan's data going back through every instance of positioning that looked like this. Is that guaranteed? No. Past performance does not guarantee future results. That disclaimer is real. But look at what that number is actually telling you. It is telling you that the moments when everybody is the most scared, when retail is dumping stocks 7 days out of every 8 and institutions are sitting at maximum bearishness, those have historically been setups for recovery. Not tops. Not the right time to sell. Setups for the next move up. The panic is the signal. It has always been the signal. And the people receiving this JP Morgan report already know that. They have been on the other side of retail panic for decades. And for anyone watching from Europe, your market is in a similar extreme position right now. JP Morgan's data on European stock positioning shows that following setups like the current one, European equities have historically returned approximately 7.7% over the following 3 months on average. Both markets. Both showing the same extreme bearish positioning. Both showing the same historical pattern of recovery that follows it. You now have the same data point that institutional investors are working with. The question is what you do with it. And that depends entirely on which of the two scenarios plays out. Let us get into the playbooks. Bullish scenario first. This is the world where the ceasefire holds and the macro environment starts to normalize. JP Morgan has a very specific roadmap for what happens in this world, and it starts in a place that most retail investors never even think about: the US dollar. JP Morgan expects the dollar to pull back in this scenario. Sell off. Come down from current levels. And if you understand how the dollar connects to everything else in the market, you know why this is such a big deal. When the dollar sells off, gold goes up. Silver goes up. That relationship is one of the most consistent things in all of global financial markets. Gold and silver are priced in dollars worldwide. A weaker dollar makes them cheaper for every buyer outside the United States. More demand, higher prices. It is as simple and reliable as financial relationships get. So precious metals are on the bullish list. But JP Morgan is not just talking about gold and silver prices in isolation. They are specifically flagging the miners, the companies that physically extract these metals from the ground. And there are two reasons for that. Reason one is the dollar weakness we just described. When gold goes up 10%, the mining companies that produce it often go up significantly more because their operating costs are relatively fixed and the entire price gain flows straight to the bottom line. You get leveraged exposure to the underlying move. Reason two is recent changes to metals tariff policy. Modifications to how metals trade across borders have a direct impact on mining company economics and on how capital flows into the sector. This story has been buried under the louder geopolitical headlines, but it is a real driver of where institutional money is moving right now. Precious metals and miners are on the JP Morgan bullish list. The dollar weakness thesis connects them directly to the geopolitical normalization scenario. And the tariff policy shift gives them an additional independent catalyst that most people have not even registered yet. If you have been sitting in gold or silver positions and wondering whether to hold through the noise, this is what the report is saying about the macro backdrop for those positions in the bullish scenario. And if you have not been in that space at all, this is the framework for why the smart money is starting to look at it. Dollar down. Metals up. Miners up even more. That is the first leg of the bullish playbook. Now let us talk about the equities and the specific order they move in. On the equity side, JP Morgan gives you a very specific sequencing for how the recovery unfolds. And the order matters a lot if you want to get positioned before the money moves rather than after. First, Russell 2000. Small caps go first. Every time. This is consistent with how risk-on recoveries have always worked. Small cap stocks get sold down the hardest in a risk-off environment. They are more sensitive to domestic economic conditions, they have thinner balance sheets, more exposure to credit markets. That same sensitivity that makes them fall hardest is what makes them bounce fastest and furthest when the risk appetite returns. The Russell leads the recovery. Second, NASDAQ. After small caps kick off the move, the next wave of buying flows into tech and growth names. This is where the hedge fund leverage rebuild plays out in real time. All that deleveraged institutional capital coming off the sidelines and moving back into the Magnificent Seven and the broader NASDAQ. The snap that we talked about earlier starts here. Third, the broader S&P 500. The full market recovery comes last as capital broadens out from the leaders into the rest of the index. Beyond that sequencing, JP Morgan is calling out specific sectors to watch. Consumer discretionary. Home builders and retailers in particular. The thesis here is that as the macro picture improves and consumer sentiment recovers, spending follows. Home builders have been in a genuinely brutal environment for months. Valuations reflect that. When sentiment shifts, the valuation gap closes fast. And then financials. Banks. This is one of the more interesting calls in the report because everyone has been running away from banks. Retail has been selling them. Institutions have been cautious on them. But here is the setup. Banks report their earnings early in the season. JP Morgan expects those results to be solid. Lower oil prices reduce inflation pressure. An improving macro environment reduces credit stress. In that combination, bank earnings land well and the market has to reprice a sector it has been selling for months. That is the most reliable pattern there is. Bearish consensus meets strong fundamental results and the repricing is violent because so many people are on the wrong side of the trade. So the bullish equity recovery in order: small caps first, NASDAQ and tech second, S&P broadly third. Consumer discretionary and home builders in the middle of the move. Financials printing strong earnings and re-rating from a beaten-down starting point. That is the roadmap for the world where the ceasefire holds. Now let us talk about the other world. If the ceasefire collapses, the cascade that follows is not subtle. JP Morgan has mapped it out specifically, and I want you to understand it with the same clarity as the bullish scenario because both are genuinely on the table right now. The central risk is Saudi Arabian oil production. If hostilities in the region escalate, there is a real possibility that Saudi production gets disrupted, either from direct attacks on the infrastructure or from the broader breakdown that accompanies a wider regional conflict. Saudi production going offline is not a regional story. It is a global story. It changes the supply and demand equation for oil for the entire world immediately. The specific variable JP Morgan flags is the Houthi movement out of Yemen. This is the faction that controls access to the Red Sea. And the Red Sea is not an abstract waterway. It is the corridor that connects the Gulf region to the Suez Canal. An enormous volume of the world's energy trade flows through there every single day. Ships carrying oil, liquefied natural gas, consumer goods, industrial materials, all moving between Asia, the Middle East, and Europe. If the Houthis move to fully close the corridor, the disruption hits immediately and hits hard. In that scenario, JP Morgan sees oil going to $125 per barrel. And if the escalation continues, the report references a path toward $150 per barrel. Now trace what $125 to $150 oil does to everything else. Inflation pressure comes roaring back. The Federal Reserve's job becomes dramatically harder. The soft landing narrative that markets have been pricing in collapses. The US dollar strengthens sharply as global capital moves into safe haven positions. And when the dollar strengthens, gold and silver sell off because that inverse relationship works symmetrically in both directions. Virtually every major equity category gets hit in this environment. Tech sells off. Consumer names get crushed. Financials come under pressure. Even the 8.2% historical recovery pattern we discussed becomes irrelevant because the macro shock overrides the positioning dynamic entirely. But here is what you always have to keep in mind. Even in that world, the money goes somewhere. Capital does not evaporate. It rotates. It leaves the sectors getting destroyed and it moves into the sectors that benefit from the exact same conditions that are destroying everything else. That rotation is where the opportunity lives in the bearish scenario. And JP Morgan is very specific about where the money goes. We cover that next. Oil goes to $125. Maybe $150. The dollar strengthens. Equities sell off broadly. So where does the money go? Energy stocks. This is the obvious answer, and it is also the right one. When the commodity you produce goes from $70 to $125 per barrel, your revenue explodes. The integrated oil majors see their earnings surge. The exploration and production companies pulling oil out of the ground see the value of every barrel they produce jump dramatically. The oil services businesses that drill wells, maintain infrastructure, and move product around see surging demand for everything they do. In the escalation scenario, energy is essentially the only large-cap equity category that goes up while everything else is getting hammered. Oil services and storage companies in particular. These are not the names you see in the headlines. But when oil spikes on a supply shock, the downstream infrastructure becomes enormously valuable. Storage capacity, pipeline operators, the companies that physically handle and transport the commodity. These names participate in the oil price move with less of the exploration and production risk. Defense companies. When conflict escalates, defense spending accelerates. JP Morgan flags specifically that a $1.5 trillion defense budget is likely to move forward in the escalation scenario alongside a $200 billion supplemental defense spending package. That is an extraordinary direct injection of government capital into the defense industrial base. Weapons systems, aircraft, naval assets, electronic warfare, surveillance equipment. The contractors building all of that see surging revenue that is essentially guaranteed by government spending commitments. Defense is on the buy list in the bearish scenario without any ambiguity. Fertilizers. Less obvious but important. Major global fertilizer supply chains run through and adjacent to these conflict zones. When the shipping corridors that carry raw materials for fertilizer production get disrupted, fertilizer prices spike. The companies that produce and distribute fertilizer benefit directly. This sector moves quietly in lockstep with geopolitical energy shocks in a way that almost never gets covered properly. And on the other side, airlines. This is the sector that gets absolutely destroyed in the escalation scenario. Jet fuel is an airline's single largest operating cost. No ambiguity on that. When oil goes from $70 to $125 or $150, the economics of running an airline deteriorate catastrophically. Smaller carriers face survival questions. Even the major airlines see profitability wiped out. If you are looking for where the most concentrated pain lands in the bearish world, airlines is the answer every single time. Two scenarios. Two completely different sets of winners and losers. The smart money has both mapped out. Now so do you. Let me make the bigger point here. Because this is the thing that changes how you see the market permanently once it actually clicks. The market is not one thing. It never has been. It is 12 sectors and money moves between those sectors constantly. Every single day. On the worst days in the overall market, there are sectors receiving capital inflows. On the best days, there are sectors where money is quietly leaving. The story you get from mainstream financial media, markets up, markets down, everything is great, everything is terrible, that binary framing is completely useless for understanding what is actually happening. In the bullish scenario right now, the money is flowing back into tech, into small caps that lead the recovery, into precious metals and miners on the dollar weakness thesis, into consumer discretionary as sentiment recovers, into financials going into a strong earnings season. In the bearish scenario, that same capital rotates entirely. It flows into energy, into oil services, into defense, into fertilizers. It floods out of airlines, out of consumer names, out of tech. The money is always moving. That is the only thing that is constant in financial markets. And your job, the only job that matters as an investor, is to understand where it is heading before it gets there. Not after the price has already moved and the headlines are telling you what you missed. Before. This is why the J.P. Morgan report matters. Not because you should blindly follow every sector call in it, but because it gives you the framework for the two worlds we are living between right now. Both of those worlds are possible. Both of those worlds have clear winners and losers. And the people who understand that framework going in are the ones who do not panic when the narrative shifts overnight. Retail investors have been selling 7 out of every 8 trading days. The historical data says the 3 months following extreme bearish positioning like this have delivered 8.2% average returns on the S&P. Hedge funds are deleveraged and ready to flood back in when the signal clears. Tech is heading into earnings with suppressed expectations and battered valuations. The S&P target is 7,200. That is what J.P. Morgan told the people with the most money. The full playbook. The full framework. Now you have it too. The gap between institutional investors and retail investors is not intelligence. It is not instinct. It is information. And closing the gap is why we are here. Stay informed. Stay ahead of it. We will see you in the next one.